All right, perfect. Let's go ahead and let's begin. So let's go ahead and get straight to everything. I don't like to talk too much. I like to just get in, show you guys exactly how to do things, have you guys, understand the chart and be able to read it, and then go over risk and money management game plan. Ultimately, at the end of this 3 days, you should be able to be self-sufficient. I'm going to give you the tools that you need to become successful, tools that you need to stop losing money, and then tools to be able to stay long in this game. So first things first, we always have to have a risk and money management game plan. When I first started off trading, I didn't have one. I placed, 20 standard lots on Euro US dollar at one time. I stacked my positions. I did things that I should not have done. So let's go ahead and let's walk through a risk and money management game plan. So one of the first rules that's important is, go ahead and actually put this text back. I want you guys to risk 1 to 2% of your total equity. Does that make sense? Do you guys know what equity means? So risking 1 to 2% of your total equity per trade. So if you have a $100 account, you are going to only risk 1 to 2% of that entire account on one trade. So 1% is about $1, 2% is about $2. So that comes down to whenever we're trading, if we're trading Forex, we're trading lot size recommendation 0.01 to 0.02. Now, if we're trading options, it would be about one contract. So with options, it would be about one contract. There's no reason to place more than one contract. You do not need to have multiple contracts to make money trading. Same thing with Forex. You do not need to have standard lots or mini lots to make money trading. There's times where we place 0.01, 0.02s on a trade, and it's ran $20, $30, $100 in profit. The best way you are going to make money is by buying or selling and holding your trades. Remember, it is not the great calls that make you the most money. It is the great holds that make you the most money. The trades that you can buy and sell and hold from, a couple months to a couple of years. So options position sizing one contract. We're going to look for anywhere from a 3 to 6 to 6 to 8 portfolio. Long, short portfolio. So basically what this means right here, 3 to 6 to 6 to 8 long, short portfolio. So we are going to be holding these trades anywhere from 3 to 6 to 6 to 8 months. Oops, right there. So we're going to hold our trades anywhere from 3 to 6 to 6 to 8 months. Long, short, meaning that we make money when the market goes up and when the market goes down. That's how we're going to have our position sizes. Recommended trades a week, actually a month. I would take about 5 trades a month. Sometimes we don't even need to place more than that. Reason why is because we are focusing on quality, not quantity. There's no reason to place, 20 trades in a day, 20 trades in a week. That's just super unrealistic. Don't do that. That's how you lose money. 5 trades a month. 1 second. I'm going to answer questions after this. Only invest in things you know. This is super important. So what do I mean by only invest in things that you know? If I ask you how the U.S. economy is and you don't know, then you shouldn't invest in equities, indexes, or currencies that have to do with the U.S. dollar. Same with any other currency. If I tell you, hey, you know what do you know about Boeing stock? If you know nothing about Boeing stock, then you would not want to go ahead and place a trade in Boeing stock. Do you know why? Because if you have absolutely no idea what this company does, then you should not be an investor or trader in the company. It's important that you know both technical and fundamental analysis whenever you're going in. This is super important. There's people who invested in gold. There's people who invested in bonds. There's people who invested in oil, especially oil. You don't want to trade oil if you have no idea what moves the price of oil, what crude oil is, inventories, oil rigs. You don't want to get involved in oil if you have no idea what it is, or else you will get destroyed. So 5 trades a month, only invest things that you know. Never get emotional with a trade. Super, super important. Never get emotional with a trade. If you place a trade, you have to understand when to cut your losses. It's important to have a stop loss. You always want to have a stop loss on your trade. Getting emotional meaning, like, let's say that you buy a stock. The stock goes down 10 points. Your stop loss is 30 points. Stock keeps on going lower beneath 30 points. You're like, oh, I think it's going to go up. I think it's going to go up. No, you don't get emotional. You stay with your trading game plan, and you close that trade out at your stop loss. Always have a stop loss. It is super important. You never want to trade without a stop loss. That is like a really, really big rule. Never stack positions. What do I mean by that? If you place a buy on any financial instrument and then it goes down, do not place another buy. Keep your entry. That's it. Have your stop loss. That's it. Have your take profit. That's it. Trust me. This is going to help you so much, especially risking 1 to 2% of your total equity per trade. The lot size recommendation, the option sizing recommendation. There's a lot of people out there who do not follow this. They just want to make money quick. They want to make money fast. They think they're going to get rich overnight. They think that they can just jump into the market and then hold their whole financial situation. All their debt is going to be paid in a matter of months. That is super unrealistic. We are here for the long run. We are not here for the short run. So what kind of trader am I, and what kind of trader am I showing you how to be? Swing and position trader. So what exactly is a swing and position trader? A swing and position trader will hold trades from a few months to a couple years. We are long term. Remember what I said. The long-term money is going to make you the most money. There's no reason to, like I said, place 20 trades on one stock in a week, 20 trades on one Forex pair in a week. If you see a long-term buy, a long-term sell, you know that price is going to go that way, which I'm going to show you guys after the Risk of Money Management game plan, you will be straight. This is so simple. It is easier said than done. Another one. Know when you're up to stay out. So what do I mean by that? Knowing when you're up to stay out. If you get into a trade and let's say you're in a pretty good amount of profits, does it mean that you go and look for more trades? Definitely not, because what if those extra trades that you look for start going down? It eats away from your total profit right now. So if you place 3 or 5 trades the whole month and they're running, should you look for trades next month? No. If you close and liquidate one of those trades, okay, you can look for 1 trade. If you liquidate 2, okay, you can look to add 2 more on. You have to know when you're up, when to stay out, and when to keep these trades and when to hold these trades. You also have to have a game plan too. You know, what are your goals? What are you trying to do? What's a realistic amount of money that you can make with your account balance right now? Think about it. How much money do you have in your Forex account or a stock trading account right now? If you're looking to make back anywhere from 3 to 6, realistically, we should be looking to make anywhere from 5 to 8% returns. So 5 to 8% returns we should be realistically looking at. If we're risking 1 to 2% to make back 5 or 8% every time we win a trade, it is super important that you guys follow that. Last but not least, focus on winning months, quarters, and years. Fuck the daily goals. If you're the kind of trader where you have daily goals, I want you to drop that shit right now and do not do that. We are not focusing on winning days. Hold on, someone said something in the chat. Yeah, there's no reason to look for days. There's times where in the market, there's no trade setup. What do you do if the market's not setting up? For example, yesterday in the Forex market, our Forex trades have been going up 10 pips, down 10 pips, up 10 pips, down 10 pips, up 5 pips, down 5 pips. It's not doing anything. It's just consolidating right now. So if there's no trade set up and you want to make $100 that day, what are you going to do? Most likely you're going to try to force yourself into a trade. And if you force yourself into a trade and you're not confident when you place a trade, guess what's going to happen? You're going to lose the trade, or you're going to get so anxious that you're just going to close the trade out. Does that make sense? Type 1 if that makes sense. I want to make sure that makes sense. Perfect. If something doesn't make sense, let me know. Like this is so crucial. If you focus on winning months, quarters, and years, you're going to be straight. I withdraw my money from my trading accounts every quarter. Whatever my bills are for the next 3-4 months, hopefully I make enough money to pay all that off. And if I do, great. I just paid all my stuff off until the next quarter. And then I keep on doing that. That works for me. And it's been working for me. It's important that you find, when's a good time to withdraw your money. I would say every quarter, like myself. The money that you make, you reinvest it. When you get to a point like me where you've made a lot of money, then you can start taking some money out. Of course, you're gonna have to go with an accountant. You guys are gonna have to have a tax strategy, how you're gonna pay yourself. That don't focus on the accounting part, and don't focus on the tax part until you're making roughly maybe like 5 figs a month. Or maybe like if you're making more than $3,000 a month, $2,000 a month. Then by the end of the year, you can go talk to an accountant. So you guys can go ahead and screenshot this. Super, super important. Easier said than done, like I said. Perfect. So let's go ahead and let me introduce you to Ichimoku Kinko Hyo. This is literally the greatest indicator ever. Let me go ahead and figure out how to turn these candlesticks back on. Perfect. So what we're looking at right here, let me actually go ahead and delete this. This is a candlestick chart. I'm assuming that all of you guys understand what a candlestick is. So the kind of configurations I use is right here. You're going to want to right click, go to color theme, put dark. Then you're going to double click on the candles and then make your candles purple, and then make sure the opacity is 100%. I do my bullish candles purple, my bearish candles white. Super, super important. Whatever's easiest for the eye will be best for you. 1 second, let me turn off this light. All right, perfect. So let's go ahead and get into looking for the trades and finding trades on here. So the way to set up Ichimoku Kinko Hyo, you go to indicators, you type Ichimoku cloud, you click that. Now it's on your chart. So you're going to come here to settings, go to style. Your conversion line is going to be the 9-day moving average. You're going to want to turn that blue. Your baseline is going to be a 26-day moving average. You're going to put that yellow. The lagging span is going to be 26 days behind price. I'm going to go ahead and explain this to you guys. That's orange. Lead 1, green, of course. Lead 2, red. You're also going to want to go ahead and bring the opacity up too, so you can darken the line. Super important that you guys do that. Always, always do that. And you want to make it the second thickness over. There we go. Now you can see it a lot clearer on my chart, right? Look at that. So much more clear. And then for a plots background, you're going to have green. Where's the opacity at? Here we are. The opacity is down here. Perfect. Where's that at? Just lost that. So the opacity, I mean, you can do it fully red. I don't really do that. I do it halfway or so I can see whenever price inside the cloud, what's going on in there. Shoot. I think this was green before. I think I might have messed it up. Yeah, that's green. All right, cool. All right, sweet. So whenever we're looking at this chart, you're probably looking at it like this is really confusing. Watch this. So let's go ahead and talk about what's going on in this chart. Let's use a better chart like Netflix, for example. So Ichimoku Kinko Hyo works best for, this is a trend following indicator. This is going to be used for long-term trends, swing trading and position trading. It works easily to find entries, but I would not use Ichimoku to scalp. This is really great for anything that trends, Forex pairs, stocks, bonds, commodities, anything that is a trending market. If you want to know what a trending market is, look at this. Where is Netflix going? Clearly up. There's only 3 ways the market moves: Up, down, and sideways. Do you trade in the sideways market? No. You trade in the markets going up? Yes. You trade in the markets going down? Yes. That's why we have a long and short portfolio, meaning that we make money when the market is going up and when the market is going down. So when we throw Ichimoku Kinko Hyo on, you can see that the lagging span is about 26 days behind price. The way we use this is support and resistance. Do you guys know how most people use support and resistance like this? They do this, and they take their support and resistance right here. Fuck all that. You don't need to use that. Your new support and resistance is right here. Do you see where the lagging span dips right here? And then right here, and then right here, and then right here, and then right here? This is your new support and resistance. Right where the dip is, right there. You see how it lines up perfectly with that low right here? That is going to be your new support and resistance. So if we go ahead and put that here, we use the horizontal ray. You find the horizontal ray by clicking here and coming down. You're going to place it here and here. I wouldn't necessarily, you can place it there too. That's a pretty good level. So that would be your major support. Your major support and resistance are always going to be on the monthly, weekly, and daily. Anytime you see these dips on here where it reversed, is we're going to go ahead and place your support zone. For example, right here, look at this. What do we have here? Support. So that's how you use the lagging span. That's one way you use the lagging span. I'm going to show you a different way with the lagging span later on. So with Netflix, here's what we're looking at right now. We have the 9-day moving average and then the 26-day moving average. So the 9-day moving average is the blue line that basically counted the last previous 9-day closes. And this one moves a lot faster. This one isn't as slow as the 26-day moving average. The 26-day moving average counts the previous 26-day closes. Now, how do you trade this? The first thing I do is, a lot of people, they look at the 4-hour chart. If you look at the 4-hour chart, this is confusing, right? It's kind of like hurts your eyes. You can't really tell where the overall trend is. You can't tell where the money's going. This would confuse you, telling you the money's going to go down. So we always start off on the monthly chart. The reason why we start off on the monthly chart is so we can see the overall picture. We can see where the longer term money is. I don't care about the 1 minute, the 5 minute, 15 minute when I'm looking for long-term trades. I want to look at the monthly chart. I want to be able to see the bigger picture, and it's easier to go ahead and make my projections off of that. Also, the pullbacks of these moving averages are way better to catch. There's a bigger percentage that they'll come down on one of these moving averages and then bounce off. So first things first, I don't want to look at just this. This is not enough data for me. Data is the 9-day, the 26-day, the cloud, the lagging span, the candlesticks, and the candlestick formations. I want as much data as I can before I enter a trade. I want to make sure when I go into a trade that I always have 3 or 5 confirmations on why I'm buying or why I'm selling. If you can't think of 3 or 5 reasons on why you're buying and why you're selling, you should not get into that trade. Also, on a scale of 1 to 10, if you're not confident in the trade, don't take it. Trust me. There's times where Amazon, I knew Amazon stock was going to go up, or I knew US dollar Turkish lira was going to go up. I saw it on the chart. I knew it was going to go up, but I just wasn't confident. I wasn't feeling right on it. It went up. I wasn't confident, and I stayed out. Totally fine. You know what? That's totally fine. I had to work on something right there. I had to work on some things, but at least I stayed true to my game plan. I am a disciplined trader. I am so disciplined when it comes to my trades. If I don't like something, I'm not going to trade it. If something in my risk and money management game plan or my trading game plan doesn't go right, like the steps before I go ahead and enter a trade, I'm not going to take it. Why? Because if I do something that I know has hurt me in the past, there's a bigger chance that I can take a loss on a trade. I mean, I don't mind losing because I only lose like 1-2% per trade to make back anywhere from like 5-8%, 8-10% per trade. I'm cool. I can be profitable only winning 20% of the time, risking 1 to 2%. Let's say I place 5 trades and 3 of those trades are losers. Let's say I risk 1%. I lose 3%. All I got to do is win 2 of those trades, one of those trades, and guess what? I've made that 3% back and more loss back. So I'm still ending up profitable. If it was the other way around, we had 10 trades and I only lost 3. I mean, I only won 3 and the rest were losers. Cool. If I won all 3 of them, they're averaging 5%. I've made that money back. That's why it's important to only risk 1 to 2%. Keep your losses small. Not a lot of people can do that. Once you can figure out how to do that, it's going to be a lot easier. I can show you everything. I can give you the tools right now But the only way you're going to become successful is if you go back test this, play some trades in your demo account, utilize what I taught you, mark up your charts, put in the time. You're not going to become successful at trading if you're not going to put in the time. I spend hours looking for trades. Some people think that they can look for 2 minutes, 5 minutes, and that's it. No way. Ichimoku will help you, but if you really want to find the good quality setups, the trades, you got to see the trade, and you have to look for the trade. Same with Forex pairs. I'll run through like 20, 30 Forex pairs before I find one. Anyone that's in my options alert room, and they've been on one of my options webinars, there's a time where I went through 50 stocks before I even found an entry. Took me a little bit, but that's totally fine. You have to put in the sweat equity. You have to put in the work, and you can't come in sloppy. And you can't come into the markets thinking that you can just run everything. If you think that you can come into the markets and start creating your own trends, start doing your own thing, getting emotional, you're going to lose a lot of money. And one of the most important things is risking that 1% to 2% per trade. You can be the worst trader in the world, lose every single trade, but as long as you have proper risk and money management, it'll take you at least a whole year to blow your entire account. Super, super important. All right, perfect. So let's keep on going through this. So first things first, I go on the monthly chart. This is the first thing that I do. Second thing that I do is I like to zoom out the chart. The reason why I like to zoom out the chart is because I like to go all the way to the historical start of this particular instrument. So the stock IPO'd around 2002, May 1st of 2002. Okay, cool. I can see we were into some a correction right here. Hold on. Keep the chart. Keep the chats going. I'm gonna zoom out. I'm gonna hold that question. All right, perfect. I'm gonna exit out of the chat, so I'm not gonna see anything. So I can definitely see that we had a nice impulse here. We're sitting correction sometime at this phase, and we were sitting sideways for quite some time, and we broke that correction, went to another sideways flat, broke that, and it went up from there. That's what I can see. Okay, but that's cool to know about the past, but what about the future right now? The most important thing I'm looking at is this. First thing I look at is the historical chart, then I break it down to right here. This is the cloud. This is literally the most important part of the chart. If you want to know where the trend is, you look at the cloud. The cloud will tell you. We're looking at the monthly time frame right now, right? If on the monthly time frame, price is above the cloud, it is bullish. If price is beneath the cloud, it is bearish. Let me go and show you an example. See this, the monthly chart? We're on the monthly chart. Step 1, go to the monthly chart. Step 2, unzoom the chart so we can go ahead and see what's going on in GE. All right, this is interesting, but it makes sense. We have been trending lower on General Electric since December of 2000 on this stock. That makes sense. Okay, we see that it's been going lower since 2000, so about 9 years or so. Then I'm going to go ahead and look for the trend. Price is beneath the cloud, right? So the price is bearish. This whole trend is bearish. What if price is trading inside the cloud? It is neutral. It is not bullish. It is not bearish. Only time I ever trade inside the cloud is if I know that it's going to bounce from the top of the cloud to the bottom, or if price is at the bottom, I'm going to take it to the top. I will never trade in the middle of the cloud ever. I will only trade, like I said, if price goes up to the top and I know it's going to come back to the bottom, or if price is sitting at the bottom and I know it's going to come back to the top. Never will I take a trade inside of the middle of the cloud. That is crazy. Why? Because it is neutral. You want to know when we're in a neutral market, you see price inside the cloud. Also, since we know that that price is beneath the cloud, look at this. Do you see how thick the cloud is right here? Look at right here. You see how thin it is? There's not that much volume. The thicker the cloud, the more volume we have. So if we're in a bearish market and we have a thick cloud, how strong is the selling pressure right here? The selling pressure is pretty strong, meaning that the overall trend is pretty strong too. The sellers are pretty much in control. What happens when the cloud thins? Let's go ahead and take a look here. So right here, price is above the cloud, right? We can see that. Let me go ahead and take the 9-day and 26-day off so we can go ahead and make an example out of this. So up here, price was outside of the cloud, so it was bullish. Once price is inside the cloud, right where the cloud is at, you can see the twist. Do you see that? Cloud got thinner, then twisted. Once the cloud twisted from green to red, what does that mean? It means that the trend went from bullish to bearish, meaning that price is went from long to short. So when price is inside the cloud and you saw that the Kumo twist, this is called an Ichimoku twist, also known as a Kumo twist. So if you're in a bullish trend, Then you see the Kumo twist. Guess what? It's letting us know that about a month from now, it's going to go ahead and become bearish. That's the beautiful thing about Ichimoku. It literally predicts the future for you. It makes it so much easier for you. If you can get the future predicted, price projections are easier. If you know that it's going to sell off for the next month, obviously you can go ahead and take a sell for the next month, right? The cloud is telling you. The cloud is accurate. It's always going to be accurate. So you can see right here, okay, it twisted. What happened? Wow. Price broke out of the cloud. So price went from bullish to bearish. And the cloud literally predicted that for you. Okay, then here we are. Cloud's getting bigger, cloud's getting bigger. Okay, the bigger it gets, the harder it's dropping, and the correction's going too. Does that make sense? That is a Kumo twist. Let's go ahead and take a look at it from right here. Obviously, everything right here is bearish, right? Price is trading beneath the cloud. Now price is trading inside the cloud. I would have took a buy somewhere down here and took it up like I said. That's the only way I'll do it. I will not buy right here or inside of the cloud, in between the cloud. Only on the low and the high of the cloud to take it down. Does that make sense? Perfect. So when General Electric got in the cloud, somewhere in here, the cloud went from bearish to bullish. Then what happened? Price literally stayed outside the cloud from 2014 to about 2017. So about 3 years or so. The trend on General Electric was bullish for 3 years. You could have made money for 3 years on a buy. The beautiful thing about position trading. Here's how we trade the lagging span. So you remember how I told you guys a way you can trade the lagging span with support and resistance? Take a look at it up here. Perfect example. Perfect resistance at this level, and you can see because that's where the points are, reversal points are on the lagging span. That's how you use the lagging span. That's one way. The second way you use it is right here. So you see how price is inside the cloud, right? What's the best way to catch price coming out? Look at the lagging span. This is the second way to use it. When the lagging span breaks out of the cloud and price is broken out of the cloud, that is validating the breakout. This is called an Ichimoku breakout. This works best in the 4-hour, the daily, and the 1-hour chart. Of course, it has to break out in the trend. So if the monthly chart is showing bearish and then you want to catch a breakout on the 4-hour, this has to break out in the way of the trend. Like right here, price broke out, the lagging span's broken out, but it's not validated yet. But the monthly chart's bearish, and if we were looking back here, we back tested back in time right here. If I went to the 4-hour, 1-hour, and I saw the breakout on the 4-hour, 1-hour, and the lagging span is broken out too, that validates, and that means that there's a 90% chance or so that this is going to keep on going lower because the lagging span broke out with it. There's times where price will be inside the cloud, it'll break out, but the lagging span will be all the way up here. It won't even be beneath the cloud. It won't even be inside the cloud. Guess what happens? It comes down maybe, then gets faked back out and goes right back up. That is called a Kumo fake out, an Ichimoku fake out. Because this is the cloud. This is the Ichimoku cloud, this red and green shade. Does that make sense? Let me know if that makes sense. Let me know if that does not make sense so I can see. I want to know if that Ichimoku breakout made sense to you. I have students that only trade Ichimoku breakouts, and they make a lot of money doing it, especially on the 4-hour, daily, and 1-hour. I have students who only take that trade. How do you want me to reiterate it? How should I reiterate this so where it makes sense? Yes, I'll break it down again. Perfect. So the best time frames to use the Ichimoku breakout is on the 4-hour, daily, and 1-hour. So if the monthly chart is bearish and then we have a breakout to the downside following where the overall trend is on the larger time frame, the only way it's validated is this. Price broke out of the cloud here. Okay. Now, since we saw price break out of the cloud, is the lagging span broken out? If it is, great. You can see clearly that this works. Price broke out, lagging span broke out, and guess what happened? Price continued to drop. And the lagging span's been beneath ever since. You could have been sitting in a General Electric sell from November 1st of 2017 till today. Does that make sense? It is invalidated if price broke out of the cloud and then the lagging span was above the cloud or inside the cloud, it is invalidated, meaning that it can come out and fake you out and go right back up. Let me try to find an example of this, as a matter of fact. Let's go ahead and look at Apple. Let's see here. Let's go ahead and try to find an example of this. I want to find an example of a fake out for you. Let's see if we can come across one right now. AMD. We're probably not going to find a fake out on AMD. Most likely not. Let's check out Boeing. Boeing was validated. Look, this is the 1 hour chart. Price broke out. The lagging span broke out. You could have took a holy shit. You could have took a really big buy right there. A really big buy on Boeing. For example, right here, price inside the cloud. The lagging span is beneath. You can see that price is breaking beneath the cloud. If the price breaks back beneath the cloud, it would be safe to take the trade all the way down to here, at least out of the next structural support. Let's go ahead and take a look at Roku. I want to find a fake out. If I can find a fake out, that'll be amazing. Alibaba. Let's go and check the weekly chart. Maybe we'll find one right here. Nope. It's harder to find the fake outs. Let's see. ACB. The 1 hour chart. Right here. Here's an invalid fake out in ACB. Let's go ahead and break this chart down. I want to break this chart down for you guys. So ACB, we're clearly above price right now. I think that ACB can come back down to this level down here, structural support. I can't see ACB staying at this level, then moving higher and going past $12 per share. I just can't see it. If we go to the 4 hour chart, wait, we're at the 1 hour chart? The 1 hour chart, look. You see how price broke out of the cloud right here? Is this a valid breakout or an invalid breakout? It's an invalid breakout because why? The lagging span's not out here with it. The lagging span is beneath the cloud, meaning that price can come right back down to here. It's going to get faked out. I cannot see price moving any higher from up here. You see how the distance is, how far away the lagging span even is from breaking out? The more experience you have with Ichimoku, some of this might not make sense right now, but when you go back and you rewatch these videos that you're recording right now, and you go back to your chart, and then you start getting into trades, and then you get faked out once in your life, you lose money on the fake out. Trust me, losing money is really good. It's okay to lose money. Just don't lose a lot of money. If you're gonna learn lessons from the market, you got to lose money. That's just the name of the game. You just want to lose so small where you learn the lessons to where it won't put you in a big predicament. It won't mess with your money. So ACB, that is invalidated. You guys can go ahead and keep your eyes on that. Eventually, it's going to come right back down. I guarantee you, ACB will come right back down. So that's the two ways you use the lagging span. Does that make sense now? I showed you a fake out, and I showed you exactly how it's validated. Remember, you only take these trades into the overall trend. Type 1 if that makes sense. Type 2 if it doesn't. Let me know if it doesn't. All right, perfect. So it makes sense for everybody. You're 100%, it makes sense. I want to make sure that this makes sense for everybody. It's okay if it doesn't. Complete sense like never before. Perfect. It's okay if it doesn't. If you're recording, perfect. You can go ahead and rewatch this. All right, great. So that is the lagging span. Let's go ahead and let's talk about the conversion line, the 9-day moving average. So if we go to the monthly chart, let's not use this chart. This current stock has only been around since 2015. And this is just not enough data. Let's go ahead and go to Netflix, the perfect example. So the way we use the 9-day moving average is for pullbacks. As you can see, Netflix really respects the 9-day moving average. Right here, right here, right here, right here too to go down. Respects the 9-day moving average right here. Doesn't really respect it right here. It came down to the 26-day. But the way you use the 9-day moving average is for pullbacks. So, for example, right here, you would wait for price to pull back to the 9-day before you go ahead and take a buy position. So anytime you look at the monthly chart, if price pulls back to a 9-day moving average or the weekly pulls back to the 9-day moving average, it is a good time to look for a buy. Take a look at this. On the monthly chart, actually, let's go ahead and look at Amazon. Right here. You see this? If we were looking at Amazon up here, would you buy? Definitely not. It is too far away from the 9-day moving average right now. We have to wait for price to pull back. If there's no pullback, there's no trade. What happened here? It took 2 months for price to pull back and then bounced off right here. That's how you can know when a trade's going to set up. It took 1-2 months to get up here, 1-2 months to get back down there. So if I'm looking right here, it took 1-2 months here. If I'm going to take a sell and take it down to the 9-day moving average, it should take about 2 months. However many months it takes to get to where your sell is at and back down to your take profit should take the same amount of months. And guess what? Price really respected the 9-day. Price respects the 9-day right here too. You see that? Consolidating. We had a pretty long consolidation, 1, 2, 3, 4, 5, 6 months. Guess what? Went up, came back down to the 9-day, came right back up, and just stayed above. That's one way you can use the 9-day moving average for pullbacks. We use these all the time for pullbacks. Also for disequilibrium. What is disequilibrium and how do you know? I'm going to show you guys a way that you can find a pullback 100% of the time. You guys want to see? Here we go. So here's how you can find a pullback every 100% of the time. Anytime price is too far away from the 9-day moving average, the closest moving average. So right here's the 9-day. If price is bearish, it's typically the 26-day. Typically it's that. So if price is too far away from the moving average, it's in disequilibrium. So price is going to pull back 100% of the time. Look, price pulled back. Guess what? Played on the 9-day moving average, bounced up. Let's go ahead and use QCOM, for example. This was a very, very big trade that I called with my students. This trade was insane. If you took this, it's only when the lagging span crosses over the cloud. What's the lowest time frame you can find a pullback? What do you mean? You can find pullbacks to the 9-day moving average on the daily, weekly, or monthly. This is best work on a trending chart, not a sloppy chart. As long as the trend is there, a clear trend. So for example, right here, QCOM. We took a sell on QCOM up here. How did I know that this was going to be a sell? The 9-day moving average is right here. Look at the distance from the price to the 9-day moving average. It was too far away. There was too many buyers. This was overextended. Something can only go up for so long before it comes back down. Something can only go down for so long before it comes back up. I have traders that don't even use the lagging span, don't use the 26-day moving average. They only trade pullbacks to the 9-day moving average. They like to do that. Figure out what works best for you. You may want to use just the 9-day. You just may be an Ichimoku breakout kind of trader. You just may want to use the 26-day instead. Some students only like to trade pullbacks to the cloud. That's just what they like to do. Totally fine. Whatever works best for you. I like to trade them to every single one. If I had a preference, I'm a 26-day moving average kind of guy, and I'll show you guys that. So the way you're going to be able to find out 100% of the time is if we're on the monthly chart and the weekly chart. If price is overextended and super far away from the first moving average, it is going to pull back 100% of the time, always. Okay? So we use the 9-day for pullbacks. Let me go ahead and show you guys the 26-day moving average. So let me go ahead and pull up Google. Let's try Google. This chart is too close. Best Bucks, Starbucks. Here we go. This is the easiest one. DPZ, Domino's Pizza. This is perfect. This is beautiful. This is the perfect part. Knowing when to sell. So you're gonna want to find your entries on the monthly, weekly, and daily. That's where you're gonna want to find the overall trend. You're gonna look for the entry on the 4-hour, 1 hour, or 30-minute. The smaller the time frame, the more you can reduce your risk. You want to enter your trade as if you're a day trader or scalper, because you already know that day traders and scalpers have to have their positions almost pinpoint on their support and resistance level. But you're looking at your trade long term on the monthly chart. Does that make sense? If you take a buy right here on the monthly chart, who knows? You may not even be exactly on it on the small time frame. Does that make sense? Perfect. So Domino's Pizza, for example, right here, look it up on here. Do you see how far away price is from the 26-day move? Oh, shit. Okay, we have to go back to that 90 moving average. Someone wanted to go over that. If you're recording, let's see. So you see how price is all the way up here? It's too far away from the 9-day moving average. Too far away from the 9-day moving average. Too far away from the 9-day moving average. It's always going to pull back. That's called disequilibrium. Anytime price is too far away from the moving average, the closest one on the monthly chart, it is in disequilibrium. So let's go ahead and go to the 26-day pullbacks. So this is how the 26-day pullbacks work. So how you trade these is, we're taking out the 9-day moving average. People ask all the time, what is the best moving average to take trades on? It's really up to you. which moving average, every time you look at a chart, is the most respected? Typically, it's 26-day. Sometimes on some trades, let me show you guys really quick. Facebook. For the longest time on Facebook, right here, price never touched the 26-day moving average. Look at this. For the longest time, price never touched the 26-day. From January 2013 up until last year, price touched the 26-day for the first time. The 9-day was 100% accurate, as you guys can see. Always 100% accurate. If we go to a trade like this, GE, what's accurate? Prices broke through the 9-day, broke through the 26-day, broke through the cloud. You'll just be guessing right here. You would just be guessing on these. But if we go to Facebook, I'm not going to sit here and guess. Price likes to respect the 9-day, and it shows me that price bounces off the 9-day a lot here, bounces off here, bounces off 26-day here. It really likes the 9-day moving average right here, right here, right here. So obviously, what does that mean? That price likes the 9-day moving average, and that if you were to take a buy off the 9-day moving average, there's a big chance that you'll become profitable. Facebook. So Facebook, for example, like I said, some of my students like to take trades only to the 26-day. Why? Because the 26-day is a higher time moving average. It moves slower and reacts more heavily to price. Same with the cloud. Like I said, some students like to take pullbacks to the cloud. They feel really comfortable taking pullbacks to the cloud. If you're going to take a pullback to the cloud, you're going to be waiting, months before it pulls back down to there. So, for example, on Facebook, let's go ahead and look at Amazon, AMZN. Need to find a good example on this. Right here, Amazon. Amazon pulled back down to the 26-day. I remember telling all of my students to buy right there. Really, really big profit right there. Domino's Pizza. Let's go ahead and take a look at that. Domino's Pizza, very good stock. Barely touched it, but I still called to buy on that trade. Boeing, BA. Nothing there. Microsoft. Let's see if we have any pullback. We don't have any pullbacks down there, but it can definitely pull back to the 9-day moving average. This is super overextended. Perfect example right here. Way overextended. I wouldn't sell Microsoft. I would wait for the pullback on Microsoft before you go ahead and buy. That's the safest move. Anytime you place a trade, you have to know what the best move is. That's why I don't just go into a trade like, okay, I'm just going to buy if price goes down to the 9-day. No. What if price goes down to the 26-day? You have to know every single scenario to every single trade that you place. You never want to go into a market, into a trade, thinking one way. What if price is this? What if price is that? What if price reacts to 26-day? What if price reacts to the 9-day? What if price breaks through the 9-day? What if price breaks through the 26-day? Where am I going to have my stop losses? Where am I going to look for my take profit? What kind of candlestick would I like to see before I go ahead and enter? What is my position size? You have to ask yourself so many different things. You have to be, you can never go into the market just one way thinking. Never. A lot of these blue chip companies, they don't like to pull back down to the moving average anyway. So let's go ahead and take a look at Alibaba. Alibaba is kind of funky though. Always breaks through, but goes right back up. Let's see. Google has pulled back down before plenty of times. Whoops, my fault. So for Google, this would have been a really good buy right here, and then taking it right back up. Look at what's interesting on Google right here. So let me go ahead and show you an example. Yes, Uber would bounce off the 26-day. What do you mean, Uber? Let me check that out. On the 4-hour, yes. This is such a brand new IPO that we don't have enough time. We don't have enough data. That's why I called the buy on Uber to everyone in the academy. We're gonna keep a buy on Uber because I want to take it down to the 26-day. I'm comfortable right here. I think that 46. Look at this. It took how many days to get down here? 1, 2, 3. If we can bounce off this level right here, it should take 3 more days to come right back up to about 146 or so. So however many days it takes to come down, it should take to go right back up. So if I was to go ahead and get an options play on this, I mean, I can go ahead and get 2 weeks out, but I would like to get anywhere from 2 weeks out to 3 weeks out. I mean, 2 weeks out to a month out. In case something happens, that would give me some time in case price consolidated a little bit, then started to move its way up slowly. That would give me some time. You can trade stocks in the Forex account, yes, if your broker has it. So back to what I was looking at. Let's go ahead and look at Disney. Not pulled back. What was I just looking at a second ago? Microsoft? No. I was looking at Facebook, I think. What was the chart I was looking at before this? Jeez, how did I forget that? What was the chart I was just looking at? If someone remembers the chart Oh my gosh. Square. All right, you know what? This is crazy. Square came all the way down. Let me show you guys this really quick. Conversion line. Square broke through the 9-day moving average, came right down to the 26-day moving average. Square has just bounced off right here. Let's go ahead and look for buys on this. I'm going to help you guys out. Okay, so here's what's interesting. If I were you guys, you see how price came up to the cloud? I would like to take Square back down to this level. If we can see Square pull back down to about 65.83, I will place a buy right there. Does that make sense? Pullbacks to the 26-day. Find entries on the weekly, monthly, yes. If you know that price is pulled back on the monthly charts at 26-day, you know that that's a really good level. That's a really good level to go ahead and take a buy. Or you know what? You can take it down to the cloud and catch that bounce too. So you're finding the bounce. You're going to go on a smaller time frame and look for an entry. If you were to buy right here, your stop loss would have to be down here. Does that make sense? If your buy is up here, your stop loss would have to be down there. So that's the pullbacks. Let's go ahead and talk about moving average disequilibrium. So we know that price disequilibrium is whenever price is too far away from 90 moving average, right? Moving average disequilibrium is when you see how the 9-day and 26-day are pretty parallel from each other. There's a pretty big gap in here, as you guys can see. You guys see that? Right there, the big gap inside the 9-day and 26-day. That has to snap back together. Whenever we see that, we know price is going to go back down. Let me go ahead and try to find an example of that. Netflix, right here. Perfect example. Here's the gap. They have snapped back together. Netflix is definitely going to pull back down to this level so the 9-day and 26-day can get a little closer. Then, once it gets down here and then bounces off these again, it's going to go higher. And then these are just going to widen out again. 9-day or 26-day are going to widen out. This is used on the monthly chart. Amazon, take a look at this. That's how you can tell for sure that something's going to pull back. Look at the gap on this. There's some pretty decent moving average disequilibrium. I'm going to try to find some severe disequilibrium on these charts. Let's see. Let me try to find something with severe disequilibrium. Alibaba. Perfect. Look at Alibaba. You see the severe disequilibrium right here in this level? Look at all this disequilibrium. What happened? Price came down, came back up, came right back down. Now look. What happened to the bands? They have connected together. Unfortunately, we're still in a bullish trend because price is currently above the cloud. But here's one thing. Price is not above the 9-day and 26-day right here. It is actually beneath it right now. It's actually beneath it. That would let us know that price can come down to the cloud and we can look to buy Alibaba at the cloud and then take it up. I wouldn't necessarily place a buy right here because you have a lot of resistance. Just like how the 9-day and 26-day can be your support, it can also be your resistance too. So with this being said, I would have to break it down to a smaller time frame. I'm not necessarily too convinced that this is going to go ahead and go higher, Alibaba. But what happened was the disequilibrium definitely has closed up. If this was above the 9-day and 26-day, of course, I'd be calling buys left and right on Alibaba, but it's not. Not every time is a trade going to give you a proper setup. Sometimes there's trades that the moving averages make sense, but then on some time frames it doesn't make sense. That's fine. Move on to the next trade. You should be able to look at these charts like this. Let me go ahead and show you guys. Dow Jones, bullish or bearish? Bullish. Price above the cloud. ACB, bullish. CGC, bullish. Kronos Group, bullish. APHA, bullish. Hexo, bullish. SiriusXM, bullish. Snapchat, no say yet because the cloud hasn't formed. It's brand new. Pepsi, bullish. Great. I literally went through 1, 2, 3, 4, 5, 6, 7, 8, 9. It took about a second to know the trend right there. Now that I know the trend, I'll show you guys another way that you guys can go through stocks really fucking quick. Right here. Is it pulled back to a 9-day or 26-day moving average? No. ACB, has it pulled back? No. It's still going to go back lower before we bounce. CGC. Okay, it's starting to bounce off the 9-day moving average. I would have to break this down to a smaller time frame to go ahead and look for a buy. I would place a buy and then have my stop loss somewhere down here. Kronos Group. No, has to pull back down to the 26-day. APHA. not ready yet. Hexo has to pull back down to the 9-day before I go ahead and look for a buy. SiriusXM has to pull back up to the 9-day to go ahead and look for a sell, or take this right back down to the cloud and then look for the buy. Snapchat, right under the 26-day. I would look to take this right back down to the 9-day moving average area. There's disequilibrium there. Pepsi, severe disequilibrium. I'd be looking to take the trade right back down. Remember what I said? I called a sell on Pepsi. I put this shit out about 4 months out, expiration date on this. You know why I did that? Because it took about 4 months to get up there. I put it out about 4 or 5 months for a price to get down there anyways. I already know Pepsi's going to pull back. It's going to pull back. Price disequilibrium never lies. It might go up a little bit, but I'm cool. I literally just went through all these trades in less than, I don't know, I probably didn't spend more than 10 seconds and already had an idea of what I needed to trade to go ahead and do. Does that make sense? That's how Ichimoku should be. That's how you guys have to look at it. This is an at first glance indicator, meaning that you glance at the chart and you can skim through all of these and you should be able to go through this fast and see exactly what's going on. You should be able to go through it this fast, literally that quick. You should be able to see. You should be able to see the trend, see where price is at. Has it pulled back to a moving average? No. If it hasn't pulled back to a moving average, it's not ready. If it has pulled back, great. We can look for entries. Has it pulled back and bounced off? Great. We can go ahead and look for entries. It's the same thing as Forex. It's the same thing. You can pull this up on a Forex chart right now. Euro US dollar. Euro US dollar is the shittiest chart I've ever seen in my life. This isn't a trend. What is this chart? This is going up, down, up, down, up, down, up, down. That's why I trade structure sometimes. Look at this, up, down, up, down, up, down, doing nothing. USD, CHF, nothing. Well, we're in a downtrend. This is an easier chart to trade right here because we have the Kumo twist. And I'm still looking for price to pull back for US dollar Swiss franc. It works for Forex. It works for stocks as long as it's trending. Ichimoku does not work in sideways market. It works in trending markets. A lot of the times on these trades, we have to wait for price to pull back. That's just how it is. If we know on a larger time frame that price needs to pull back, we're in disequilibrium, does it mean to just go start placing buys when it's going to pull back down? Definitely not. Sometimes you have to wait a couple months for the trade to set up. That's totally fine. And if you can't wait a couple months for a trade to set up, trading isn't for you. Investing isn't for you. You should go find something else to do because you're never going to become successful doing this. That's why it's important that you have a job while you're trading. Go do something. You don't have to fucking have a job where it's construction where you beat yourself down. No, go find something to pay your bills. Go find something, to do where you make money, you pay your bills, and you make extra money and put in your trading account. Don't take shortcuts. You got to put in a lot of hard work. You got to put in a lot of time in these markets, a lot of times in these charts. You're going to learn a lot of things. Some of this won't make sense until you place your first trade, right? You're going to have to place your first trade for this to make sense. So that's the moving average disequilibrium. That's the price disequilibrium. And this is the cloud. Let's go ahead and do some analysis on some of these trades really quick. Intel. Here's what we're looking at on Intel. I'm not necessarily, let's go ahead and see if we break down the weekly chart. I don't know, because we can come to this cloud, it can come up and then bounce off the cloud and come right back down. It's something that we have to keep an eye on. INT